We've got a stock that's trading at $629 a share. Looks like it may potentially be in a place where it could go higher. So we buy to open the 630 call option, slightly out of the money, and we spend, let's just make it a nice round number, $8 on it. Okay, so it was a little bit more than that, but I'm going to do some math here. I'm going to put this in red because we're buying that option. The stock looks bullish on the chart. If this stock goes higher, can we make money on this call option? Yes or yes? Yes. Okay, there you go. Where do we break even? Where do we make money on this? Where do we make money on this call option at expiration? Obviously, we could take the trade off earlier if we have a technical reason to do so, but where do we make money on this at expiration? We break even at 638. Exactly, Scott. 638 is our break even. Now, that's a ways away, but if you look at the chart of Amazon, and I'm speaking of the daily chart, by the way. If you look at the daily chart of Amazon, 638 is kind of right up here where these highs are. So if we break those highs on a breakout, we would be profitable at expiration. All right, that's kind of cool. I'm looking at this and saying we've got 4 days to get there. And, well, just as an example, in 4 days, last week, Amazon went from 607 to 638. Yeah, I think we may be able to get there. We may. But we might also, in the process, go sideways for a period of time. Or even down. Because even if the stock goes down, as long as it does not turn bearish, go below the moving averages, we still have the possibility that we could get a bounce at those moving averages in a rally. That could happen later today. It could happen tomorrow. It could happen the next day. And that rally could be a fairly nice rally that could take us back in the money. But what are we going to do while this stock is going down? We're just going to hang on to this option and let the $8 that we've invested dwindle away and hope that it's going to work out. Well, I used to trade like that long time ago when I started trading. I used to say things like, oh, it'll come back. Well, it might not, right? So what would we do? We would sell to open, in that case, the next higher strike price, the 632.50 call option, and we would get paid some money for selling that. Now, we're not going to get paid $8, right? In fact, it's going to be significantly less than that. Let's just use a nice round number of 4. The reason I like this as an initial hedge is that it does not carry the inherent risk of a credit spread because it is a debit spread in structure. In other words, if I screwed up or the market throws me a curve, it looks like it's going down, and then it shoots higher, I am not in any risk between the spread here as I would be if it was a credit spread. All that would happen is that the option that I bought for $8, the 630 call, would go up in price, and the 632.50 would also go up in price, but it would go up in price only on intrinsic value basis at expiration. So in other words, if the stock was at let's just use an example of 634, the stock rallies up here to 634, then I'm only going to lose $1.50. Is that right? $1.50 is, yeah, $1.50. Had to do the math in my head there. On this option, so this option right here would lose me $1.50. That would cost me $1.50. But this option would go up in price, right? And so I'm not at risk of having an assignment and exercise risk like I would in a credit spread. This simply becomes a debit spread, right? But if the stock does what I think it may do, go sideways to down for a day or two, what's going to happen to this option? It will go down in price. What's going to happen to this option? It will also go down in price. But I am mitigating, I am reducing the risk of this option going down by having sold this option. If the stock starts to carve out a bottom or starts to rally and go higher, I will buy this option back, and if I can buy it back in a day or two, I'll buy it back for less than 4. Maybe I buy it back for, I don't know, $1.50. Okay, if I buy that back for $1.50, then I made $2.50 on this option, which reduces my cost basis. Okay, so that is why I select the debit spread strategy first as my hedge on what is now a swing trade, a 3 to 5 day trade on Amazon. If Amazon bounces and goes wildly higher here, then great, my call option will make money. If it doesn't and it looks like it's going to go lower, then I would say that my trigger point for that to happen would be a trade below the previous day's candlestick. Right? If we start trading back down here, then yeah, I'll just go ahead and turn this into a debit spread, and then later in the week I can turn it into a credit spread if I need to.